Welcome back, master students, to week number 6, Volatility and Backtesting Criteria Part 2. We're going to go ahead and get started here into the continuation of our studies within volatility. The backtesting criteria here has already begun. We have already started to mark off iterations of where volatility meets a certain criteria. Now, that certain criteria that you're marking off is just where volatility has fired the signal, right? It is as simple as that. Now, after identifying the areas where a signal has fired, we are now going to determine what direction bias we're taking. And in order for us to do that, we are going to be using stochastic momentum. Now, stochastic momentum, it is a momentum indicator, right? Trend indicator. It is telling us the direction bias. And how we're going to use it is going to be the critical part here. When we are backtesting, when we are marking off iterations using volatility and using stochastic momentum in a pair, that's going to give us a certain criteria, right? And we're going to determine whether we're going to continue using it as such or not. And I will explain what I mean by that. In this particular iteration here on ticker symbol Z for Zillow, you can clearly see that I'm using this criteria. The break of volatility, 15%, with an upside posturing on both the moving average, cyan line, and the upside posturing of the volatility component histogram. As long as we are at or beyond the 15%, we are good. We're firing off the signal, okay? Good. Now, what does stochastic momentum suggest? Imagine that there was no price action. In fact, we can do that. Let's go ahead and kind of minimize this a bit. We're going to use the replay function, and we're going to put that there. So this was arguably the 12-hour candle just before the firing of the signal. So we're noticing at the fire of the signal that we are also getting curvature on stochastic momentum. What is the minimum time frame you would carry out this backtest? 12-hour and above? No. Actually, this we've talked about this before, but I will tell you this. You can use this on any time frame. You can use this on a 30-minute. You can use this on an hourly. Now, the reason why you would use it on a 30-minute or an hourly or a bi-hourly or something is so that you can benefit from the statistics in a shorter time frame, meaning that you want to do a day trade or you would like to do a momentum trade of sorts. Now, you don't have to. You don't have to do that. And I will say that Alpha, pass me your username. I will say that there's a lot of iteration that can happen within those time frames. Okay, a lot of iterations. And I'm not telling you this to discourage you. I'm telling you this to simply let you know that it will you won't be getting the biggest backtest of your life. As long as you are catching maybe 140 iterations minimum, then you should be okay. And I really wouldn't go under that for the hourly backtest or 30-minute backtest or 50 minutes, right? 35 iterations in one day. So yeah, that's okay. For the daily time frame, sure, that's fine. But I will say that, using the 15-minute time frames, those tiny time frames, make sure that you have 140 iterations no matter what, 140 and up for true behavior. And the other thing is that you're going to have to maintain. You're going to have to update that system continuously. You're going to have to in a 15-minute time frame. We're talking about volatility expanding and contracting at a faster rate than you would on a 12-hour or a daily. Naturally, there are. I mean, there's just a million more iterations of that criteria, right? So with that said, it's really not to discourage anyone. It's just to tell you that we should probably take this slower. And I will say also that I benefit from the back testing here using the larger time frames because I can still, even despite the tiny time frame back test, I'm sorry, the larger time frame, meaning that we're not going to be able to benefit from it on a daily. That's the question. There is, are we or are we not going to benefit from a daily? If you're creative enough, you would understand that I had to be right. You would have to be creative enough to understand that the back test on a 12-hour, minimum 8-hour, there's your answer, would be consistent for maybe a few days play. Something that can give you maybe a week or 2 weeks, maybe even a month of trend. So if you're given a month of trend or a week or 2 weeks, then you know what to trade within a day. You would trend and counter trend. And that's what creates the power behind knowing the probabilities of price action over a certain time frame. Right? Because asking is if the signal goes off in between the time selected, do we still mark off that iteration for the future? For the future, you're going to mark off that iteration when it's done. So when the signal fires off, meaning when it breaks above, remember using the criteria, when it breaks above the 15%, both the moving average and the volatility component, as long as it's within the 90% and the 15%, that's your condition. If it enters either extremity, the signal will then cease to exist, and that will be a completed signal. And then you would measure what happened to price action during that signal, and then you have upkeep. Your maintenance continues. Guys, is it really sounding distorted? Okay. Hold on. Just a sec. Okay. Still robotic? Okay. Good deal. Not sure really what happened there. But yeah, keep me in the loop. Let me know if that goes away. Okay. Let's see. All right. Let's see. Keep you in the loop. You are the loop. Okay, guys. So now, yeah, now that we're good to go, do you remember the last thing I said? I can follow up from there. I'm not exactly sure what was the breaking point. Okay. Yeah. Okay. So that's where you left off. All right. Right. The criteria can, yeah. So the criteria will invalidate, or sorry, the signal will cease to exist. Right. That's where you left off. So the signal will cease to exist when it enters either extremities. Is that okay? I'm trying to rewind my brain here as much as I could so that I could continue as said. And then we can go about our day here. That sounds good, right? Cool. Okay. So yeah. Signal ceases to exist when it enters either extremities. Remember that the signal will also cease to exist. Just to be safe, let's start at week 1. So right. So remember, guys, the signal fires off at or beyond. So it'll also terminate at or beyond the 15 or 90. So here the signal fires at the break at 15 or above, right? Using both of the components, the volatility read being the histogram and the moving average, breaking above that with an upside posturing. That's your criteria to fire. Now, the criteria to end it does become a little simpler. You will have to choose where you want your criteria to finish. Would you like your criteria to finish at the volatility, meaning the histogram, touching 90% or above? Or are you going to wait until the moving average also crosses into 90% or above? That's going to be the age-old question for you. But whichever one you choose, there's no right or wrong answer here. Whichever one you choose, you will have to maintain robotic consistency in the backtesting that you will be performing moving forward. Okay. And it'll be particular to the time frame of the particular asset, right? With that specific condition repeated over and over. Now, the reason why you do this is to maintain stability and maintain a high quality backtest. So Niz is saying, I think safe bet for histogram to touch and to touch and aggressive if both go over 90%. Whatever your criteria is, remember. But it has to be the same choice for both 15 and 90%. Actually, you have a different criteria to fire than you do to invalidate. So you can create one profile of firing and invalidation. That would be your criteria. My personal criteria is that anytime that volatility component touches alone, if it touches either extremity, I will completely kill the signal. Because then I'm gonna experience iterations where there was too long, right? It was too long of a duration because I'm waiting for the moving average to enter. Right? So I'm not gonna wait for that. Jen, same situation with you. Okay, good. So I believe the iteration will start kind of going a little too long. Sure. Yeah. Why don't we find one here and see what happens? Here's one. Well, actually, I'm going to give you the full criteria. All right. Here, let's use this. Let's pretend that we're backtesting for the downside on this particular iteration. The firing of the signal would arguably be right about here. Okay. Now let's zoom in just to make sure that we are firing off correctly. And it looks like we are not. We are not at the 15% here. We are before the 15%, as you can clearly see. So that means that our iteration is incorrect. It would be here instead. What if it never touches it will. You're talking about monthly time frames. You're going to have to choose a time frame that's small enough to where you do catch the oscillation between extremities. The larger the time frame, the less likely it is for it to reach extremities. So if you're looking at a quarterly chart in an asset that doesn't have enough trading history, you're probably not going to catch the oscillations of both extremities. You would just have to diminish the time frame. Yes, sometimes you do have to zoom in. And this would be the firing of the signal here. So let's just make sure that it's clearly visible. Now, what I'm showing you here is that, as you can see, we fired the signal, and even though it contracted, we never touched, right, the 15%. But right in here, bam, volatility touches within the 15%, but not the moving average, which means that we still have maybe one more tick to wait for the continuation. Now, what happens at the next point? You are betting the downside. You go immediately volatility to the other extremity without the moving average as well. So now the other moving average, you're thinking to yourself, damn, if I did this criteria, I would have benefited from that enormous downside all the way through. This would have been a false iteration. But look what happens. Bam, you touch the extremity here without the moving average, so your signal is still fired, either side. You're getting the massive downside decline here, right? And then you wait for the moving average to finally get inside, which is right here. So at this point, you're opening the signal here at 47.82%. This would be your complete criteria. Now, during this phase, you are actually waiting a total of about 18 days, 24 bars, 24 12-hour bars. And in the prior criteria, you were just really waiting around 13 days. Actually, it would be around 13 days or 19 bars. Now, would you benefit from this using that other criteria every time? Well, that's where you would have to find out. It's part of your criteria. You know, but the reason why I'm saying this is because if you're playing options contracts, it would be different with shares. If you're playing with options contracts, this entire consolidation here will IV crush anyone. So you would probably be returning 50 or more % of your gains if you get IV crushed here. And if you are in the money on your options contract, then you should be okay. You may release only about 25% of it. Only about 30. Shouldn't that iteration be green? It looks like I was just giving the example of where the signal fired. Remember that I was teaching how to backtest the upside first. But in this instance here, this was the total iteration here. This was the complete instance. So in this case, sure, we benefit from the downside. It would be in your discretion here to take profit at a certain place, because if I'm measuring the downside, I am measuring from the firing of the signal as such. The signal fired at the open of the 12-hour bar, which would be right about here. And it would be a range low. So the lowest that price action went during that phase, which is right here. To me, this is where the signal ended, not here. Now, the signal ended here because that's quite literally as low as price went during this phase. So it would be, yes, on this one, I'm backtesting the downside. That's what I started off with. I started off with saying, let's just go ahead and backtest the downside only for this one iteration. Stocks Chick asked me for an example where volatility fires the signal, but we are using both the moving average and the component to invalidate the signal when it enters either extremity. So this was a great example because we had no moving average inside when volatility went inside 15% of contraction, and also no moving average when we entered 90%. So both of these this was a great example overall. And it just so happens that we could have benefited from it. So if we benefit from this, that means that we could have had a great shares play, meaning that we benefit from the absolute bottom of this signal before we had to wait another who knows how long till here, right, when it started to finally fall below. And we're talking about $45.45 dropping from $56. So that was almost a 10-point move within about 17 days. Now, you're thinking to yourself, crap, is that actually worth the time? Because there was a deviation from this. During this moment, on margin, because you're shorting, right? You are going to be down about 4.5%, very, very, very close to your stop loss. My personal stop loss on shares is somewhere around 6, maybe 7%. At these points, I'm getting nervous, and I'm talking about getting nervous for days, right? And also, I would never hold a short overnight. Short positions overnight means you're holding margin overnight. You're holding lever overnight. And that's, I will not. I will play my short position on a daily basis and I will close it on the daily. You don't want to mess around and find out, right? Not with margin. Infinite potentials there. Let's see. And Ned's saying shorts overnight are horrible, especially if it gaps down or gaps up. Yeah. Now, Ripe saying, how someone who lost 200K holding shorts on Dow? Oh, my goodness. Yeah, that would be. First of all, you're using, for example, let's just say this. You put in $200 into a levered account, you're going to get $400 with margin, and you're using $300 or $350 on a short. You know, you're going to be losing, and it goes against you, right? It goes to the upside instead of the downside. That's going to be losing 150% or 200% at the speed, you know, because you're levered. At a certain point, you're going to get margin. You're going to get margin called. They're going to call you and they're going to tell you to serve maintenance on your margin. They're going to tell you either release the asset or deposit more money, or release other assets so that you can have more cash availability. If you are a retail trader, you are not getting a slap in the hand. If you're a retail trader, you're getting an ultimatum. Either cover it or lose it all. Right? Because this is like credit. Right? Think of it as credit when you're using a short. And it is as such. You do not I guess you know what, where you could short on cash would be on platforms like Webull. However, there is a minimum to short on Webull. If you carry an account that has $2,000 or more, you are able to use the short. And here's the thing. I'm not even sure if you have to enable margin to do that as well. But I think, guys, don't hold me to this. I'm not too familiar with Webull's everything, right? But I think you may be able to short on Webull on a cash account $2,000 or greater. But I may be wrong. I actually think it's 2,000 and margin. But still, yeah, margin is typical for having. Margin is a very typical thing to have or to be required in order for you to play short anything, any instrument, any asset. So here's your criteria. It's going to be up to you to think, and you may have to do this a few times just to understand, am I going to benefit from the extremities using the moving average criteria? So either it enters it or it doesn't, but maintain stability and maintain your posture, right? If you're able to maintain that and be more robotic about your back testing, then you will benefit from your output data. You will ultimately be benefiting from this. Okay. Now, remember that this was just the one iteration here that we used for a potential back test to the downside. Okay. But that's my invalidation criteria was here. Let's look now. Wait for it. Let's look now if we were backtesting the upside, because we are. This whole time we've been backtesting the upside. This is the break of volatility. At the opening of this bar, we're waiting for the signal to continue to the upside here based on that read. And it looks like I got the invalidation by about, I would say, this point here. Now, the invalidation meaning that my particular invalidation to read the data here would be that between the firing of the signal and where the signal ended up invalidating, which is right here, this was the highest that price action went. And that's how I am marking my odds. Now, you're thinking to yourself, yeah, we got a huge upside here at the break. Using the moving average method, it looks like we could have benefited even from from a higher valuation. But the problem here is that during this entire time, you went in at this point here. So the signal fired off on the 12-hour time frame opening bar. You were up who knows how much, and then you were down more than your stop loss. And then you were up who knows how much at this point. Now, are you willing to take that? Are you willing to take that? It's just that's going to be up to you. In my personal opinion, I want to maintain a shorter phase. You know what I mean? Because our discretion is going to tell us where that higher probability resistance would be. Because we can already see that if we're entering here, or if the signal actually fired at this point, we can even wait for the closing of the signal. Because this thing was still suggesting a little bit of downside, maybe one more bar, then we'll pivot. We're able to see all those things, and we're going to learn how. And if you look at local inflection, this would be your inflection point here. That's your resistance. Right? Okay. Now, if you're looking back, you'll also notice that, damn, that is an area that we used here to validate a resistance before continuation to the downside. It looks like we also used it right here. Wait a second, right here as well, but not only right there as well. That gives you the biggest hint. This one. Why? Because after this capitulation event, that is exactly where price action stopped. So your criteria would be, screw it. I'm going to go ahead and fire off the signal here. Yeah, I do have a probability of going beyond the target that I think it's going to go to. But with my discretion, I'll take advantage of a shorter term play and take profit at this level. So if you open up at the close of the 12-hour bar, and now you're noticing that on the next bar, you're like, oh, wait, we're shifting. Wait, let me get another candle closure here on a 12-hour bar to get maybe some validation. So screw it. We're going to do this. Let this 12-hour bar play. Do not enter risk. Wait for the 50% pullback. It closes. You get the 50% pullback. You're entering at around 41.20. This thing pulls back all the way, right? All the way to 40.62. You're still within your stop loss criteria. You already entered here at the 50% retrace. You take that input, you take that entry, and you wait for that continuation to the upside. So not only were you waiting for the condition or for the criteria to officially fire, but you were paying attention to volatility, it not to reach the extremity. But you were waiting, most importantly, for stochastic momentum shift towards the upside on a 12-hour bar, which is great. So you entered risk right at about this 50% pull, or you entered risk at the opening of the new bar at its 50% and continued. Regardless, it's 40.90. So you continued, and you continued. And at this point, you're thinking to yourself, well, the plan isn't to stop here. The plan is this target because of this happening here. And because of this, I mean, we clearly see a very, very distinct resistance. So you're taking this resistance here no matter what. So you set your stop. So not only were you patient and you were able to benefit from a move that's a lot shorter than its true iteration where it would invalidate somewhere, you're not going to know where it's going to invalidate. But you may know where the top of the price action will be during a phase using your discretion, using price action. It's not about top ticking the play. It's about being consistent and taking profit during that play, even if you're wrong about the top. We're not looking for the absolute bottom. And what I mean by we're not looking for it is we're not looking for it to trade it. We are looking for it as far as charting it, sure. That's where we do market off. The probabilities of price action reaching back to these levels up here of around, I'd say 58.61 become extremely great. I don't even know where price action is right now, but if I were to just kind of zoom out, I bet anything that we continue to that target at a certain point. And it looks like we're heading towards it right now. Right? But I'm not going to wait for that. I'm not going to wait to be, remember, our entry was here 40.90. We came up, huge profitability. We came down in the negative. We came up, and up, huge profitability. And then guess what? All this, we were massive profitable here. And then again, back to negative, right at 40.90 again. I don't want to do that. I would rather benefit from the trend. I would rather benefit from the upside signals being fired with a certain criteria, using inflection points, using ATR, using whatever it is. We benefit from the shorter term. That's what created the most successful institutions that we know today. That they were able to benefit not from the longer hold. Yes, they benefit from the longer hold, of course, but their performance and their competitive edge came from shorter bound trades, from shorter time frame trades. Once they started to switch their strategies into shorter term trades, we then started to create very competitive, long or short institutions, hedge funds. Okay. Now, the reason we would use stochastic momentum, coming back here for you, okay? The reason we're going to use stochastic momentum from the firing of the signal potentially here, right? We're already seeing that the volatility component is firing off on a 12-hour. Very cool. We want both of the moving average and the volatility component to be pivoted towards that upside. And the reason why I personally do that is because I want the moving average to suggest that there's continuing upside volatility. That's the reason why. It doesn't have to be your criteria. I just feel that there's a deeper validation when the moving average is pivoted towards the upside, suggesting that volatility is moving towards the upside. Not price, volatility expansion, upside. Okay, so let's go ahead and just press play on this and see what happens and when the signal fires. Okay, so the signal fired quite literally on the next bar. Bam. Right there. Instantly, the next 12-hour bar, right next to the one that we were on, magically goes right into volatility expansion, breaking the 15% with both the moving average and the volatility component. And this is sitting at around 70%. I'd say about 68.9% volatility. Stochastic momentum upside bias. You're in the bullish control zone with an upside bias on both of these. That's reason enough, right? Now, using in price action, since you're firing off the signal right about here, you're waiting to enter. Why are you waiting to enter? You're waiting to enter because you're breaking above a major resistance range. That's right here, right? All this chop area here is validating the break of this zone. You have to wait for it, right? Your local resistance right here is finally being broken. So you're catching, you're waiting for the entry, right? So you're going to wait for the break of that zone, and let's see if we can have price action pullback at a certain area. I'm not sure if it's going to happen. Remember, I don't know. This is all, I'm looking for it like in the future here with you. The risk is that we would enter the market at around 56.53 to around 55.65. We may not get it. But let's plot it out just like we do every single day when we go to the market prep. This is entry number 1. Let's go ahead and identify with moving averages what's sitting below us. SMA 10 is confluent to that on a 12-hour time frame. Daily time frame SMA 5 confluent to that as well. Let's see. What about a 4-hour? I know there's a million moving averages here, guys. I apologize. Okay. The 3-hour time frame is looking okay too. And that is marking off the SMA 50 at a lower point. I don't think I would take that. I want to see where the where the SMA 200 is within a shorter period. Or the SMA 50. The EMA 21, all right, screw it. Let's use that. But I'll use it on a daily. Or maybe on an 8-hour or 6-hour, something like that. Let's go ahead and get those in there. I'm going to remove the SMA 5, SMA 10, SMA 20, keep the 50, 100 and 200, EMA 7 out, EMA 9 out, EMA 20 out, EMA 30 out, EMA 50 out. Let's go ahead and maintain custom EMA length number 2 at an EMA 200. Let's get rid of the volume weighted moving average. We'll keep the 200 as well. And now, okay, let's see. Good deal. 6-hour EMA 21 confluent to our bottom side here. Let's see the 4-hour. 4-hour EMA 21 confluent to our discretion too. 3-hour EMA 21 confluent to our section here too. Hourly time frame EMA 21 and the SMA 50 completely confluent to our range. So we could arguably think that it would be within the hourly chart to enter risk using the signal. Okay, now what does the ATR say though, right? So let's go ahead and pull up here average true range to observe the historical value. Current time frame ATR. $0.67. So where is, let's go to the 12-hour bar and minus 67 cents from where we're opening, right? So right around here. And we want to minus 67 cents from 57.52 because we believe that the entry could be within an hourly time frame. So yeah, it's in here, right? You're looking at this zone here because if you're thinking the exact math would be around 56.93 for the 67 cents, great, but that's not what you're doing. You're looking at price. You're looking at inflection, not at the exact value of the average true range. So this would be equivalent to that. Good. Okay, so if we have a further downside, can we identify a second entry? Of course, it would be this. So let's mark off a secondary range here in case price action gets there. Here we go. Let's mark off the receipts. Of course, we need the 50%. Entry conditions are in. We want to see if we could get the pullback. And if we can't, there is further analysis to be done, and we can go ahead and enter the market even still. So let's go ahead and press play, and let's see if we have any conditions there. There. Okay, entry number one. Well, zone number one has been achieved. Let's see. Okay, EMA 21 approaching. Bam. Secondary zone reached, 54.67. Okay, are we entering stop loss or are we not? Okay, let's go ahead and measure. We have a 7% stop. Let's say that our final entry was right about here. So we're going to have to split the difference. Our average is probably around, I'm going to be shy about this, or I'm going to be aggressive about this actually. I'm going to say that our average from entering at 56.56 and also the bottom range of that 54.03 would be around 54.70. Let's mark off a 7% stop on this. Let's do 6%. 51.58 will be your criteria to stop out. Okay, so since we have that, let's go ahead and mark it off like this. Our average is somewhere around here. Risk is going to be right about here. And oh man, you can even choose this, right? We're looking at a 50-50 split here. Like, is it even worth it? Are we going to leave the runners in there? Because our take profit target would actually be around here. Right? Nonetheless, let's go ahead and see what's up. Bam, we took profit. But are we leaving runners? Oftentimes we do. Leave the runner. Let's let it see where it went. Right? So from our entry criteria, I'm playing options on this. We're looking at about a 7% gain on shares, but on options, you're looking at a 54.86 average entry to 58.72, picking up whatever your delta is for every dollar increment that you make to the upside. This was probably a 200 to 300% gain on options contracts, depending on how volatile that was, and it looks like it was. So the short-term play absolutely worked out here. Even if you were to manage your risk here, maintaining maybe an overall, let's just say, yeah, we'll measure this from the entry criteria. Maintaining a 4% stop loss for your play. And maintaining a 7% expected value per share. You're leaving your runners though. Okay, now how would you know where price action is going to continue to? Because great, we got our play. That criteria was done. By the way, team, I'm diving into executions here. This whole time you've been getting executions with this, just to give you an understanding over where you're going to go when this class finishes, which by the way, we are halfway now. I'm introducing executions to you so that you can decide whether you're going to take that mentorship with me in the continuing weeks after strategies is done. And the same email you've been talking to me about, reach out to me there, and I'll go ahead and start giving you the syllabus and all that information there, and I'll start taking the seats for that. Okay, Hydra, I love it. So here we go, team. What we're observing here is a combination. Niz, I love it, dude. Thank you, guys. I really can't wait for you guys to take this. Financial saying, say less. The execution is a critical thing for us, because if we're observing here a potential head and shoulders, well, that may not be the case for everyone. In fact, let's in fact, guys, send me the email at the same place where we've been talking, and I'll make sure to get you guys in. I'll send you all the information literally just when you send it over, send over your inquiry. So let's get rid of all the drawings here. We already know, we already did it, we already played it, everything is good. So where you're thinking you have a head and shoulders, downside is coming, that may not be the case overall. Because if we start moving the time frame a little bit higher, and even yet a little bit higher, I always do this with you guys, maybe even a little bit higher, then you start to identify a bull flag. And it's not a head and shoulders. In fact, it's a macro inverse head and shoulders. So we have several targets to look out for here. Number one, formation strategy against these statistics that we're on. Measured bull flag would be from the top of the price action on the bull flag to the very bottom on a trend line. Apply the trend line to the very top of that formation. Take profit target is quite literally the close of this 12-hour bar at 65.11. Good. You benefit from the bull flag. Continuing targets would be identified using the inverse head and shoulders. Shoulder, head, shoulder. Let's go ahead and mark off the regression here. The regression, in my opinion, and I like to keep this very, very humble, I think would be this. Center of your inverse head and shoulders to the very, very lowest part where the head is located, that trend line gets marked off as the expected value for the future in the breakout of this formation. That would lead to $77.11. Great. Do we have anything else that can give us a higher probability resistance? Certainly we do. Now we are playing here a tri-formation. I'm introducing to you, again, what we've been learning. Here we go. We have a potential very rare breakout using this channel here. Could it be that we're observing here this very confusing formation to identify a higher probability target? First of all, this is bearish. Second of all, it looks like the biggest bear flag in the world. But what does the stochastic do? We have another earnings beat. They have great positive forward guidance. We have a massive inverse head and shoulders with a bull flag. Probably going to make this a tri-formation. So this is going to more than likely become a rare breakout. We have target number one. We just met it. We're risk off. Wait for the pullback. We're looking at around 59.59 to around 56.46 roughly. For the next expected target to be 77.26, we take the profit. We wait for the validation to break and confirm this support. Continuation to the upside to give us the next target. Measure your channel. Largest width, and then put it at the breakout expected candle. Let's just say that it would break out around here, or maybe on this one here. $119.56 would be the next target on this. We could literally choose to remove risk anywhere within that, like right here. That would be an area to remove risk. So we're going to mark off a line there. The next area to remove risk if price action continues, let's mark off a little bit of a zone. I would say right around here. These are 4-day candles. Right? That's you removing risk as you go up because you left runners. Okay? Let's go ahead and press play and see how this moves. Okay. Why did it stop? Are you expecting? Yes. What do you think is going to happen? Let's hold on. Don't answer that lightly. Don't. Hold on. There's a reason for this. Don't answer it lightly. What's happening on our macroeconomic data right at this moment? What is our answer? What just happened why are we suggesting upside, and why are we going to negate a very bearish macro formation? Buzzman, very, very good. A 50 bip rate cut. Interest rate cuts. I just pulled off a cliffhanger on charts, yes. Housing, well, yes. The thing here is that it isn't only housing. We're talking about, what I'm saying here is that when you rate cut, it makes it easier for the consumer to borrow money. That means that there's going to be a cheaper rate. So when they rate cut, that means that your interest rates on credit cards, on home loans, on used cars, all of that lower. That's right. So that means that these tickers, Zillow, Carvana, right? All of those types of tickers will likely inflate. They will go up. The bonds become less attractive than other instruments. That's right. So it's going to be risk off bonds, risk on equity. That's usually what happens. So here is our next play. I bring to you Zillow because it's already been riding that top side. We need to perform a back test on this. The reason you're using stochastic momentum is to determine what direction it's leading in. What direction is it leading towards? Stochastic momentum is leading towards an upside in the 4-day. Okay, that's cool. But what about on a daily? Are we getting ready for a pullback? Yes, we are. 12-hour time frame. We're getting ready for a pullback. Yes, we are. But if we look at a macro, look at that. Bullish control zone, upside pivot, massive volatility spike. Bi-weekly chart. Monthly chart, huge upside on that volatility. Massive upside on stochastic momentum. I am waiting. Quinny, baby. So I am waiting here, guys. This means that if we are about to plan this is a very interesting time. Number one, what time frame did we just close and how can we use it for our upside? Answer me the question. Yes. Dea, let's kill it. We'll do it together if you want, buddy. Ripe images, that's right. We got a weekly close. The weekly time frame is indicating here a 50% prior bar retrace. But wait, we also got a bi-weekly. And what does the 50% of the bi-weekly tell you? I spoke about this entry already. $59. I told you that I would wait for the pullback on this to $59, potentially gain entry around there. And it just so happens, without looking, I'm doing this as brand new with you right now. Without looking, the 50% prior bar retrace of a bi-weekly is literally $59, which marks off the top of this inflection point. That's what I'm waiting for. Quarter close is coming in about 8 days. That's true. Do we have a further pullback on that quarter? What's the 50% of the quarter candle? The quarter percent of, the 50%, 55.35, 30% of the bar, $59. Okay, so we have confluence here. We are talking about an aggressive entry between $55 and $59. The critical part here is to break this resistance, 67.21, closing this quarterly bar in 9 days. Let it start decompressing, but I would say a weekly, actually. I think that the quarter bar would be a little difficult here. The quarter bar is breaking above its inflection point. It would be best if the quarter closed above 57 to about 61. Close it above that 61. Then we convert that 57 to 61 into a major support. Our stop loss is below $57. Share trade. Okay? That means that we're about to gain risk. We're going to execute within the 55, right? The 55 to 59 area, and wait for the rip and wait for the closes to be above the 65 zone. This major inflection. Once we break that 65 zone or 66, the next target on this would be $86. I am talking about a live play here. I believe that my master students on strategies are good enough now to put down a thesis, to look for our fundamentals, to look for the statistics, enough so to make this an actual play, which makes this class particularly interesting. This is a damn field trip, and we're about to take on it together. Okay, team. So I'm going to touch on stochastic momentums here in a more brief moment at a later time. But just to give you a quick little hint, the 12-hour time frame, or it doesn't matter where it is, right? It could be your daily. It really doesn't matter. Just look for the time frame that you want to backtest, and everything would be good. Guys, no. I'm not gonna give you homework here on this week. The homework is gonna come next week because this is not enough. This is not enough. But what I want you to do is backtest whatever time frame you think using the suggested continuation to the upside via stochastic momentum. Okay, so if you're at overbought, then that's okay. Then go up to a higher time frame. You're still at overbought on a daily. Buy daily is still overbought as well. It looks like the 3-day time frame is invalidating at this present moment. What about the 4-day? 4-day time frame looks like it fired off a signal right here. Still has the upside probability. That's one assignment for someone, not as a must. You backtest the criteria. You choose. In this case here, you would be choosing the criteria without the moving average entering the critical zone. Without it. With or without it, you're good to go. But if you maintain consistency and you backtest this on a 4-day time frame with only the condition of that volatility expansion with the moving average, without the moving average, you may dilute the amount of information you get. I would personally suggest with it and without it. 4-day time frame is one. The reason why is because on the 4-day time frame, you already probably reached the average move by here. But you're not looking for the average move. We're going to learn how to create the standard deviations from here. Mark off the iterations only. You do not have to measure them just yet. But while we do this, you will know that some of my more advanced students in here will already have the data collected, and I will also have calculated the standard deviations with them too. So you're going to be shadowing, as a newer strategy student, you will be shadowing the live play and marking it off just like we do too. I'm planning on recording an individual video here to show you how to measure the iterations. And then we could go ahead and go over it live. So expect the video coming out tomorrow, team, just specifically for strategy students. And I will have you continue observing how to use both of the stochastic momentum indicator and the volatility in linear with measured iterations. Class is now over, team. Let's go ahead and please remember, send me the email if you want me to just go ahead and give you the executions syllabus and that whole thing. So I'll go ahead and give you that syllabus disclaimer and all that good stuff. Now that we're about halfway through strategies, I would like to start preparing that and making sure that the house is full for the continuation into executions mentorship. I'm in every single course forever now. Right. I love you, dude. So yes, guys, please send me the emails to the same place, right? ARCmasterscourse@gmail.com, the same one that you reached out to me on. I'll pass you over that information. Let's get you secured on your seat, and I will start building the execution stage. Ripe said you're stuck with me forever, man. You can't get rid of me now. You are simply stuck. So now Torito saying any course, if you have a cooking class, let me know. I'm in. Any course. Turbo saying, so I'm down for that next course, but that's only if you're still okay with continuing our dude. Turbo, what are you talking about? Your education comes first. Everything else comes secondary. Okay. Thank you, Alpha. I really appreciate that, guys. And trust me, I take this. Guys, I'm not a perfect trader. I take it extremely personal when one of my plays goes sour. I have trouble, because it's like it's a lot of my I care about my students, I care about the risk that you put on. Right? I love you, Turbo. That's amazing, my brother. So I get bothered by that, team, because I don't want to lead you off of a fucking cliff. I don't. Buzzman saying true. Remember a couple weeks ago, ARCa broke a monitor. I did. I have to not do that. I have to not do that. Thank you, Yardeline. Thank you so much. I'll make sure to pass you the disclaimer and all that stuff as soon as this is over. Guys, I have to not do that. It's a brand new thing to me to work on my overall psychology, considering all of you too, right? Because when I'm good at facing a loss myself. I'll be like, you know what? Well, I'm down. It sucks. I have to just, I have to move along, right? And create the next one and whatever. Right. And but when it comes to I just faced a loss alongside 50 of my students or 50 of my trading team, that weighs a lot. And I have to work on that. So this is why I say all the time, guys, on this one, risk less. Like this is not, and I will be honest with you. And I'll tell you when I'm going to size hard. I'll tell you guys, I'm going to size into this play. Thank you, Hydra. Yeah, guys, send that email. I'll go ahead and send it to you. Sorry. I can write it here, team, of course. It's the same one where you inquired initially. And this is going to be for the executions mentorship. Man, guys, you can see that we were talking about executions and we had to kind of like speed up, right? And we stopped the execution process a little early. That's because the world of execution is vast. Because there's a strategy to enter, and there's a strategy to exit, but not only strategy to exit, the strategy is also there to lose. And the strategy is also, regarding execution, the strategy also continues into strength. And it also continues into loss. Because we want to improve the rate of gain as we go up, but we also want to diminish the rate of loss as we go down. So all of that, guys, there's no way I can do that in a 4-hour session with you. You're hearing that right. I couldn't sit there for 4 hours and show you what I just told you, which is one execution criteria. That's one. The entry, stop loss, take profit, continuation, or the decline. That's one criteria. I couldn't do that in a 4-hour session, let alone, I don't even think I could do it on a 5 or 6 hour. But this is why we need to segment it. And this is why we need to create a system to enter and to exit, guys, because you are building a system. The system is you. This system will be you. And if the system works, then you have a probability base that you can always follow. Your system will give you a statistic. Does it work? What component within the system do I need to remove or attenuate? What has to be modified? What has to be completely removed? What needs to be added? What needs replacing? The system will be continuously attenuated per ticker. You're never going to use the exact same thing on every situation, which is what we're doing here, building the strategy. And I told you that volatility was way too big. I can't do it. I need several weeks, which is why hence the 12 weeks of strategies, So, Ripe, we can't handle in, let's see, all you can learn buffet from ARCa. We need it done in smaller meals. Yes, it's going to, dude, that's going to be, you're going to throw up all night. Buzzman saying, ARCa, did you have a 3-day back test? Wouldn't work in a current conditions for Zillow. I actually don't have any back tests for Zillow or Jen. I actually don't have back tests for Netflix as well. But I am willing to work with you guys to see if you want to continue this. But Netflix could be a good downside play, and Zillow could be a good upside play. Okay, Niz, thank you, my brother. I'll get you guys squared away. And let's see, Turbo saying, good shit today, ARCa. I got a jet. Take care of some things. Love you. Okay, my brother, please be safe. I'm sorry that I didn't answer your thing. I love you, dude. I will talk to you very soon. Yes, of course, Jen. Oh my God. And systematic approach, Alpha. That's yes. If we approach this systematically, then we can get systematic results, which arguably puts in the remove all emotions aspect to the trade, but I got to say that I don't entirely believe in that. And you guys will know when we reach psychological strategy. Let's see, Niz. Okay, I got you the email. Okay. You'll do a 3-day Buzzman. Okay. And, if you need help, let me know. If there may be a lot of iterations there. And Ripe saying, I think I'm going to have to rewatch the last 2 classes to grasp all this a bit better. Yes, I will encourage that. And remember, if you do have the time, come by on Monday, and we're going to go ahead and expand on this a little more, because we'll have a little bit further of information leading into Monday, because we're probably going to pull back. We're going to be entering the potential entry criteria. Ripe Images saying, okay, brother, you booked it off on Monday. You'll be here. Okay. All right. That's what I will tell you guys, team. We're going to get into a zone to where things are going to become these are your critical weeks, They truly are. We're going to be good. And sorry, guys. I realized this and decided to book time off work to focus. Damn it. Okay, Dea. Okay, you're going to do the weekly, right? Okay, take the weekly, brother, and then we'll continue to revise this. Please be well. Be safe. I hope you rest well. I know that it's getting late there for you, buddy. Let's see. So Turbo saying you were on a double top on a 12 hour. So the pullback is imminent to start now. That's right. Good eye. Right. So we're using the psychological formations, right? Your double top on a 12 hour. Sure, man. That'll do it. You'll tweezer that. All right. Saying test number 4 coming in on that channel. Exactly. And which is what I think we may actually do here. We may actually just spike up, quick little wick to 69.96, which is also $70. 70 would be the break of a $10 range, which marks off total resistance, right? On a psychological level, the break of $10 on a weekly close. bi-weekly close. Come on, man. It's like that all is speaking pullback. All of it. The entire thing is. Oh, it is. But yeah, guys, keep the questions coming in if you do have them. Everything good. But yeah, I think we have some interesting plays coming up. Let's see. And test the center of the channel before liftoff. Yeah, that could very well be it, right? We're thinking around $55. Remember 55 to 59? Very keen eye, my brother. Good job. Hydra saying, I know you have tons of DMs. If you don't mind, take a look at my DM and let me know your thoughts, please, brother. Okay, yes. I will look out for your DM. Oh, it came in. I see it. I see you. Jen, I see yours there too. Okay, guys. Chad, I see yours too. Let's see. Would you also use the options chain as a way to... Yes. Oh, my God. Always. Always, always. To try and find out the sentiment on this stock. Guys, within strategies, you're also going to know strategies trading of earnings. Like the earnings play strategies. I'm talking about on the call, which is very dangerous, but I'm going to teach it. I'm going to teach you how to determine and how to open risk and how to close risk during an earnings call. And that I will tell you right here and right now. Most of the professional traders that I know and that I observe make their biggest gains during earnings season. That's the time to lever. That's the time to really bring in the gains, but it's also the time to really lose. So I want to make sure that you guys are chart masters to execute earnings. That is something I do not want you to risk on unless we have absolute certainty over, guys, I am talking about, guys, do not do it or else you will lose. Okay? Or else you will lose. This has got to be the last thing that I want you guys to execute. It's the last thing I want you guys to execute is on earnings. That's going to be where we top ticked our after executions, after everything. So strategies via earnings plays will be taught here. Okay. And sorry, let me just see. Let's see, Rap saying, would you also use the options chain? That's right. Yep. It's not only the sentiment, but also to gain the target. You know, we have a lot of things that we can do there. Very much. Where's the chat? Why is it disappearing? Here we go. Is the signal firing you are marking from the momentum, not the volatility, right? Volatility. It's from the volatility always. So I'm firing it from right here. On a 4-day. Because let's see. Yep, 14.85% contraction. Break of the 15%. Upside bias on the moving average. That would be right around here. Signal fired at the open of this 4-day bar at around 46.63. We've likely already met the average upside on this. And we could be moving into the standard deviation, upper bound of the first, second, and third targets. But we're going to also learn how to calculate that too, team. And yeah, team, if our questions are coming down to a minimum, let's go ahead and close up, have ourselves a very good weekend. Jen, yes, we can talk after this, and we shall. Let's see. Hydra saying, awesome class. Thanks, ARCa. Have a wonderful weekend. Take care, Hydra. Yardline, you too. Buzzman saying, thank you for another banger class, ARCa. I love feeling pumped after a Saturday morning ARCa class, and I'm going for a drive now. Bro, skirt. Happy Doritos, seeing good weekend all. Enjoy. Okay, right. Yeah, definitely rewatching, my brother. We'll be good. Torito, you got it, my brother. You're welcome. KD, you're very welcome. Nis saying, many thanks, ARCa. Hope you and your family have a super weekend. Thank you, brother. I hope the same for you. You got it right. You too, Jen. Zoe, you got it, man. You're very welcome. Speedy, you're very welcome. And okay, Stockstick, definitely rewatch. You know, there's going to be a lot of information here. And remember that I'm going to expand on this too on Monday. So if you guys do have that availability, come on by for the live or watch it post-recording. All right, team. So let me go ahead and stop the, I'm going to go ahead and stop the recording here for the YouTube.